Hey everybody, David Piatek here talking about the interest rate reduction refinance loan. This applies if you have a VA home loan. Right now is the perfect time to refinance. Interest rates are an all-time low. If you remember a couple months ago, interest rates dropped, and since then they've gone up with everything that's happening with the whole COVID-19 situation. But since then, they've recovered and interest rates are an all-time low. So this webinar is going to empower you to make the right decision if it's for you or not. I'm going to break down what does it look like, what are some of the costs of doing these types of programs, and again, just really does it make sense, and what documents you need, and really how does the formula work, and so you can kind of get an idea of what it is that you want to do. So with that, we'll get started. So just give me 1 second. So again, today we're going to be talking about the interest rate reduction refinance loan in detail. Give you guys a quick background about myself. So I'm vice president at the Federal Savings Bank, where I specialize in helping military members buy homes across all 50 states, as well as refinance. I'm also instructor for the National Association of Realtors, where I teach the Military Relocation Professional Certification. It's a certification for realtors that want to work with military members and just have a good in-depth understanding of them. I'm also an accredited buyer's representative and a condo instructor. I also am a pre-licensed and post-licensed real estate instructor, along with being a writer for Military Times and currently serving in the Army National Guard. When we think about refinancing a home, there's a lot of things that go into it, right? I'm sure if you get a ton of mailers or you talk to friends, they say like, oh, I just refinanced, or I'm thinking about it, but there's really no clear information that's out there. If you look online, you'll see all different types of information from different lenders or different websites, and it just gets confusing. So today what I'm going to be talking about is information that is in general for the VA home loan. It's not necessarily bank specific, but I'll also give you some of those examples as well. Now, our agenda for today is going to be going over what is an interest rate reduction refinance loan, and moving forward, we'll call it an IRRRL. No, it's not your cousin, or your neighbor, and how it works. We'll also talk about the benefits of the IRRRL. We're going to talk about terminology and documents you need to have and know. We're going to go over a couple examples and things to consider when going through a program like this. So an interest rate reduction refinance loan is designed to refinance a loan with a VA home loan currently on it. Now, this can be your current primary, or if you had a VA home loan and you moved out of that property, became a second home or an investment property, you can do an interest rate reduction refinance loan on there. How many times can you, when can you use the interest rate, the IRRRL? It's after you've made 6 mortgage payments and you're able to close on your home loan after 210 days from your first payment, which is typically about 7-month mark. The typical loan documents we're going to need is a certificate of eligibility, which is something your lender can get. Also, we'll need a current copy of your mortgage statement, homeowner's insurance policy, tax bill, and ID. How do you know if you qualify? How do you qualify? Is we need to get a source of income. So what makes this program different than when you bought your home? So when you bought your home, there was a full appraisal. They got your pay stubs, tax returns, bank statements, all of that in order to qualify for the VA home loan. Well, on these IRRRLs, the way it works is all they do is verify that you are employed. It could be as simple as you collecting your service-connected disability. It could be $100 a month. That will still count as a source of income. Or if you're in the National Guard or Reserve, that also count as a form of income. As long as you have a way to verify you are employed, you'll be able to do the loan. Credit score varies by banks. The VA does not have a minimum credit score, but banks do. Just imagine borrowing your own money. You know, what credit scores would you be looking for? Banks also have those requirements. And then the other major thing that is accompanied with the VA home loan is what's called your recoupment period. The cost of doing the mortgage versus the savings of the mortgage. And we'll go over a couple examples in a couple slides. And then when we go into the actual case studies, you'll also see how that breaks down. So some of the benefits of the interest rate reduction refinance loan, the obvious one is your interest rate gets reduced, but you really need to be careful with that. And the reason why I mention that is that not all banks are created equal, and the banks that you think of that you might want to call that are military friendly, they normally charge a good amount of money to do those types of loans. This includes the 1% origination fee, along with any additional discount points, which negates doing the interest rate reduction refinance loan. So just be really careful with how those fees are structured. Yes, you don't have to come to closing with money like when you bought a home, but you just have to be careful on how much equity is being taken out of your property. But I'll also show you some loopholes on how, not loopholes, but just how to control those costs and also recoup from that relatively quick. Another big advantage is there's no termite inspection. You get a reduction in your monthly payment. You just got to really see again, does the savings outweigh the cost? And you have the ability to skip 2 mortgage payments. When you rent, you pay for your rent current. So if you pay for January 1st, it pays January 1st through the remainder of the month. Then when you make your February 1st payment, again, you're paying February 1st through the end of the month. Mortgages work different. You pay your mortgage payment in arrears. So when you make your February 1st payment, you're actually paying for January. So just like when you bought your home, if you can close on the mortgage or refinance in the beginning of a month, you don't have to make that month's mortgage payment, neither the second one. So example, if you close on January 1st or January 2nd, your first payment wouldn't be until March 1st. So you're able to skip 2 months. You're also able to have multiple interest rate reduction refinance loans as long as there's a benefit to doing the loan, which is again that recoupment period. And also if you have a service-related disability, the funding fee is waived. And if you're currently not paying property taxes, like let's say an example in Illinois, if you collect 70% or more in disability with some additional requirements with that, and your current taxes are at 0, then your new mortgage would be set up with a 0 tax amount. That does not go away because that is a concern for a lot of folks when going through this and the questions that I get. Now we're going to go through the terminology and documents that are required. Terminology, we mentioned this before, recoupment period. That is the hard cost of doing the loan versus your monthly savings. And I'll break down what hard costs are here in a little bit. We'll just look at some quick examples. If your hard costs are $3,200, you save $233 a month. Basically, you can recoup the cost of doing the loan in 13.73 months. After the 13.73 months, you will just be saving on your mortgage. Another example is $2,400 in closing costs, saving $98. This one's 24 and a half months, roughly. The VA requires 36 months, no matter if you want to do something, like let's say you want to do the refinance just to get the lower rate, but you don't meet the recoupment period, you're not able to do it. What's not included in the recoupment period is going to be your escrow. That's like your taxes and insurance. You have to set them up again. The VA funding fee is not included that. All VA funding fees on IRRRLs are 0.5%. Now that fee is also added onto your mortgage. Just like the closing costs, just like the escrow, it is all included in your, is all rolled into your balance. So you're going to see an increase in your balance. Now, when we go through the examples, you'll see exactly how that works and how that recoupment really works. Closing costs, your hard costs is your lender fees, your origination, discount, credit, flood, etc. Talk about title insurance and recording fees and transfer stamps if applicable. This also includes like states in Florida, they have transfer stamps. And then in your escrow, that's your real estate taxes, homeowners insurance, days of interest, and any additional reserves you need that go along with your real estate taxes. The VA home loan does require that you escrow your taxes. You will not have the option of opting out of that. Typical loan documents you need is a current mortgage statement. Remember, your balance is not your payoff amount. Most folks will look at their loan documents and say, well, you know, for example, $200,000 is your balance that shows on your mortgage statement. But then when we actually order the payoff, you still have to pay days of interest for the remainder of the month up until the day that your loan funds. So that has to be added on. Your mortgage statement's also going to have what your current escrow balance is. That's something you do need to know. And the benefit of watching one of these videos is you can always pause, get your documents, come back, or rewind and watch this again. It's also going to have your interest rate that's on there. You're also going to need a copy of your homeowner's insurance policy because the lender needs to know what your annual homeowner's insurance is, along with your tax bill. Why is that important? Well, mortgage companies don't always get your taxes right. So what happens is if your tax bill comes out, every place is different. Some places come out yearly, some quarterly, some every 6 months, some twice a month, just at odd times. So you want to make sure that you're watching what your taxes are doing, because if your taxes have gone up, but your payment has not gone up, that means your mortgage company is going to be short when they make the tax payment on your behalf. And what's going to happen is then your actual mortgage payments are going to go up significantly because they need to replenish that money. So always double check that. You still get a tax bill in the mail. You don't have to pay it because the mortgage company does, but you need to see if your taxes are going up or the opposite, going down. You need to get a copy of your mortgage note. You can contact your current servicer. They'll be able to get you a copy, or you can go to your closing package and get it. Also need to get a current driver's license. If you own multiple properties, they'll need to get the mortgage statement, tax bill, and homeowner's insurance from all of those as well. So now we're going to go into a couple examples, and we're going to go over two. So the first example that we're going to be going over, let me just get my little highlighter gizmo here. Perfect. So we're going to look at case study 1 where the current interest rate's at 4.375. Now, if you bought a home last year, rates were much higher, right? Right now, we're just at an all-time record low. So let's say your balance is $325, your mortgage payment $1,622, and plus your taxes and insurance of $500. And the current balance is going to be $326,100 because remember, that's days of interest that's being tacked onto that. So that's your payoff amount. On your proposed new mortgage, the interest rate's at 2.75, and you see that your balance has increased $7,560. You might be thinking, well, that's not worth it. Like, why would I be doing that? Well, let's break it down. Your new payment would be $1,362.14, providing that escrow stays the same. You have $260 savings, $260.54. Now, how do we get to that $333,660 for the proposed amount? Well, let's break that down. So you're going to have the payoff amount. In this example, I put lender fees of $1,400, title fees of $1,100, escrow, that's your homeowner's insurance, real estate taxes, days of interest, and any additional reserves that you need, and your VA funding fee of $1,660. So your total amount is going to be $333,660. So what do you guys think? Does that make sense, right? Spending over $7,000 just to save $260, is that something that you would want to do? So let's break it down from a financial side. So we know that the total cost of the new mortgage is going to be $7,560 in this example. There's a couple things that you need to make sure you write down when you look at your current mortgage statement. Before I mentioned you can skip 2 months of mortgage payments. Now, that amount in this prior example would basically save you $4,245.36, right? This includes your monthly escrow that we talked about of the $500 tagged onto that. And your current escrow balance is $2,600. Again, that's on your mortgage statement. So when we look at the total cost minus the refund is going to be your net cost. Okay, so this is something that the VA doesn't require, but this is something that I look at when we look at these interest rate reduction refinance loans to see if what makes the most sense with the money that you skip, the payments you skip, plus the refund that you get. So in this example, your total costs are going to be $7,560. That's all in, right? So I look at the entire amount minus the actual refunds that you get, right? So that's going to be this 2 month skip and the escrow balance. equals that your cost in this loan is going to be $714.64. Your recoupment period is going to be less than 3 months on a net cost analysis. Now, let's look at it what the VA looks at. So your recoupment per the VA is the lender entitled fees versus divided by the savings. So in this case, $2,500 divided by the monthly savings, basically you recoup your you recoup the cost of the loan in about 10 months. So this does pass. Now, with this and how I'm looking at this recoupment period is I always advise to take the 2 months of skipped payments plus the escrow balance and make a one-time principal reduction to basically get your mortgage to where you started. So you're not paying interest on closing costs, plus you're saving that money. Now, if you need the money, then you don't have to put it into the mortgage. You're still going to be fine, and you recoup that. We recoup that within 10 months in this example. When you make the extra payment, the one-time principal reduction, your payment will not change, but you're going to move the needle from the 30-year mark potentially down to the 27-year mark, and you're going to be paying more principal than interest if you do something like that. But again, your payment does not make sense. Your payment won't change. So does that make sense to you personally to do something like that? From a financial side, it definitely makes sense, but it also just depends on what your goals are and what's going to be coming up, which we'll cover in a little bit. So now, the next part is going to be our case study number 2. So let me just get the highlighter going here. Perfect. So in this example, the interest rate's at 3.625. Mortgage balance is at $215,000. Mortgage payment is $980.51, and taxes and insurance are $40 a month. If you go down here, again, the payoff amount's going to be higher than the balance because of days of interest. On the right-hand side, we look at the proposed mortgage. Mortgage is increasing $52.80. Your payment's dropping $77.15. How do we get to the proposed new balance? Well, we take the payoff, the lender fees, title fees, escrow, and the VA funding fee like we did before, and we total all of those up. So what do you think? Does that look like it makes sense, or it doesn't? Or is it right there in the middle where, it could make sense depending on what you're looking to do with the property? So let's break it down. The total cost of a new mortgage is $52.80. We look at skipping 2 months of payments. That's $27.6102. Current escrow balance, when you look at your mortgage statement, it's $800. So again, we're looking at the net cost of this. We look at the total cost minus the refund. So in this case, it's $52.80 minus $35.6102. And basically the cost of the mortgage is going to be $1718.38. And it takes about a little over 22 months to recoup. Now, if we look at it from the VA side, like we gave a couple before, we look at $2,500 divided by the $77, and your recoupment period is 36 months. But again, this is going to be a personal decision on does it make sense. So with that, I'm going to give you guys a couple things to consider. How long do you plan on living your home? If you're going to be selling, let's say for the first example, you plan on living in your home for 2 or 3 years, well, you're going to recoup that money relatively quick, and you're still going to save on interest and your monthly payment. But let's say in the second example, if you're going to move within 2 years, it would negate the point of doing the refinance. So think that through. So we talked about if you're selling next year, how long do you plan on holding the property? So VA home loans are used to buy a primary residence. Now, over time, you might move out of that property, or you might PCS, you might buy something bigger, but you decide to hold that property. You could turn that primary residence into an investment property or a second home. It really doesn't make a difference. On a side note, if you want to free up your VA benefits, you can always refinance into a conventional or FHA loan out of this property. We talked about that just there. And one other thing, just a side note that's not in here, if you're thinking about refinancing out of the VA home, out of a conventional loan into a VA home loan, it's a little bit of the opposite, and you own a condominium, getting condos VA approved isn't really that hard. If you guys have any questions, my contact info will be at the end. So overall, you just need to really determine what is going to be the total cost versus the savings, and does it benefit you? Now, in order to get the total cost of doing a mortgage, because it's all based on your area, purchase price, your interest rates based on your credit, and there's a lot of variables that go into that along with the market. Even though the market is constantly changing, again, right now is a great opportunity to refinance to be able to save money and ease some financial stress that a lot of folks are facing. Again, that goes with skipping the 2 months of payments. And again, you don't have to uh, bring down the mortgage balance. You can always keep that money. So, what else can you guys think of that you would want to have questions on? If you guys have anything for me or just want to learn more about the interest rate reduction refinance loan or just want to bounce something off of me, below is all my contact information. So if something comes up, please feel free to reach out and ask any questions that come about. I hope you guys learned some stuff today. And if you guys have anything else that comes up, feel free to reach out. Again, my email is in there, David at the Federal Savings Bank, or you can call me at 202-875-1010. That's also my cell phone number, so you can always shoot me a text message as well. Have a great day.